Hello, everybody. My name is Stephane Prigent. I'm the CEO of Katch Investment Group. We also have Laurent Jeanmart on this webinar, our chairman. Laurent is based in London. For this short webinar, the idea is to give you a summary of the portfolio activity for 2019, review the performance, and also give you what we are working on for 2020. So we will start with what is the most important for our investors, the performance in 2019. So here we can see the share class, institutional share class accumulation in dollar. Our target return is 8% net for investors. As we can see, during the year of 2019, we achieved that target. We can see that we do not have any negative return, any monthly negative return, which is the most important for us and our investors. We can see that the level of volatility is extremely low during 2019. Basically, the performance varied between 80 bips and 40 bips. This level of volatility depends on the level of cash that we have in the portfolio, the level of default that we may have on some loans, on the currency hedging strategies that we implement. When we use forwards instruments, obviously we have a lot less volatility than when we use options instruments. So we remain confident that we also can achieve this target in 2020, and Laurent will a bit later talk about the initiatives that we are taking to reach that target this year again. On that slide, you can see that the evolution of the geographic allocation of our portfolio. So when we started at the beginning of the year, it's true that we didn't have as much diversification in terms of geography. We now achieve the level that we wanted to reach. So we have about 40% exposure to Europe, 24% to Latin America, mainly Brazil. I mean, all of it is actually Brazil. 20% in North America. A good split between Canada and the US. And finally, we have about 7% in Asia. The cash exposure that is in that slide was as of the end of December 2019. Our cash target is a bit lower, is about 4 to 5%, and we're confident that we can achieve that target. In terms of strategies, we also reached the level of diversification that we wanted to reach. We are currently overweight on the bridge loan strategy with 45%. Our target is 35%. We are a bit underweight on the factoring with 18%, and the target is also about 35%. We launched on February 1st our Katch factoring sub-fund. And we remain confident that we could achieve, get the factoring level to 35% within the next 6 months. We also have exposure to direct lending, which is about 15%, and trade finance, it's only 6%. We want to increase that exposure to about 10% within the next 6 months as well. You can see here that the return attribution for 2019, most of the positive contribution came from the bridge loan strategy, which makes sense because this is the one that has the higher weight. We had a good exposure, a good contribution as well from direct lending and factoring. The most important for many of our investors is to make sure that we manage our asset liability well. Basically, that if we get some redemptions, then we will be able to pay them without any problem. So one indicator that we monitor very closely is the liquidity profile of our portfolio. As you can see here, we have assets that are available within 1 day, basically the cash, where it's about 7% at the moment. Within a month, 10%, within 3 months, 35%. So if we sum up those 3 periods, we get to 52%. And that's basically the short-term money that we will be able to return to investors in case we get redemptions. If we compare that to what we can see on the left-hand side here, those are the exposure to our biggest 5 investors that sum up to about 23 million, and that represents 40% of our portfolio. So the size of our portfolio at the end of 2019 was about $60 million. It went up to $70 million at the end of January, but this picture is at the end of 2019. So what we can see is that we have 52% of our assets that can be returned within 3 months, and our biggest investors only represent 40%. That's usually an indicator that a lot of analysts use, and we can see that we have a good buffer to protect the fund against potential redemptions. On the right-hand side, you can see that where our investors are coming from. It's interesting to see that we have a perfect 50-50% split between our European investors and with our Latin American investors. I'm now going to give the floor to Laurent. Laurent's going to give you an example of a recent deal that we added to our portfolio, and then he's going to talk about our initiatives for 2020. Laurent?
Thank you very much, Stephane. Can you hear me, everybody?
Yeah, I can hear you.
Thank you very much. And welcome to this webinar. I'm based in London, where I head the US real estate investing effort, and some aspect of operation as well. As Stephane said,
Laurent, I think you have to speak up a little bit. You're a bit too far from your micro.
Okay, thank you. I'll try to be a bit louder.
Yeah, that's good.
The opportunities that we get on trades in Katch come from various places, and we all are part really of the origination team. We get many requests on a daily basis to fund particular opportunities, the vast majority of which we typically do. But of course, now and then, through our connections and through our current business, we do get interesting risk return suggestions. And a typical example of that was that we have funded recently, portfolio now, is a loan that we've extended to a company in Brazil.
Laurent, I think there's a problem with your micro. Do you think you can increase the level of your voice again? Sorry for that.
Yes, no problem. So basically, I was saying that through our network and our existing book of business, we do get inquiries for funding loans in various jurisdictions where we are present, and one of them is Brazil. Those who know us know that we are very active in Brazil. I always say it's the kingdom of factoring, and we do a lot of purchase of invoice there through our FIDICs. But we also have excellent connections with existing businesses there. And one of them is a business that has the right to exploit the Starbucks franchise. So those who like coffee know that Starbucks is probably the best known brand in terms of coffee retailing business. And for a very long period of time, it hasn't been present in Brazil. A few years ago, a group that was funded by an American gentleman coming from a quite a prominent family in Texas, acquired the brand of Starbucks in Brazil, and is built a conglomerate of three different businesses. One of them, and the biggest one of which is Starbucks, to try and replicate effectively what was done in Mexico, where Starbucks was extremely successful, where the penetration rate was growing very fast, where the business had very high profitability. And so he started with opening restaurants in Brazil. The business, obviously, at the beginning was supported by strong inflows of cash that was put to use to develop the franchise and open restaurants. And we got involved because the company at some point had very high operational gearing, and just like any or the vast majority of fast-growing companies, the company was cash hungry. In other words, it was growing very fast, developing very quickly, but those sort of companies, they need injection of cash to sustain their capital expenditure. At this stage, the company was reaching break-even. It was starting to make profits. It was actually quite quick in the life of the business. And we decided to make a loan that was secured by the whole group for a few million euros. And that loan, we negotiated a rate of interest payable every year of 14% in euros per annum. For us, it was a very interesting risk-return reward because we had the guarantee of the group itself, which has a collateral that is about like 5 to 10 times, depending on how you value different pieces, 5 to 10 times the amount that we lent to this company. We realized that initially the negotiation was for 14% in dollars, but we realized that owing to the cost of hedging against Brazilian reals, the company had no intention of hedging its currency risk. So we quickly said, can we do that in euros? For them, it's basically the same thing. For us, it means that we make another 200 basis points of profits per year, simply because we hedge back our euro exposure back into dollars, which adds about 200 basis points per annum. So we ended up with a loan that gave us 16% in dollars per annum, with a very fast-growing group that has a rich profitability, with a very clear visibility in terms of strategy and where they want to go. And most importantly, with very strong collateral. So for us, it was a no-brainer. We did the loan. We have contracted with a local entity, a local business, a consultancy that is specialized in auditing companies such as Starbucks. They have a franchise that is specialized in retail, and they make sure that the company is essentially being run the way it should be run, that the money is put into use, and that the profitability target and various milestones are reached according to the business plan. And so far, we are very happy with our investment. It's going very well. In fact, some of our investors have asked us if they could invest alongside us. So it's all going in the right direction. We're very happy about this loan. I think it's a good example of what we do and how we source opportunities through our network.
Okay, thank you very much, Laurent. Before Laurent starts to talk about our initiatives for 2020, I will ask our attendees if they have any questions to start to ask them now, so then we can start the Q&A session with some questions already. Laurent, do you want to talk about what we're working on for 2020?
Yes, of course. So 2020 is a very important year for us. 2019 was a year where we expanded our product offering, and where we launched our real estate fund, which is essentially a fund that finances developers in the UK, small like projects. In 2020, the beginning of 2020, our assets under management was 850 million. We had about 30 staff across the group, and so we were quite happy about our growth. So our main product, as you know, is the Global Lending Opportunities Fund, and this is the fund where we're always looking to extend portfolio diversification, the source of returns, but with always obviously in mind to allocate capital in short-term liquid private debts with very high degrees of collateral. In that spirit, we have launched these days, literally, last week, our third sub-fund, which is the factoring fund. And as you probably know, this is a fund that is dedicated to buying invoices in Brazil, but with a very important value addition, which is that we purchase a credit insurance with a top-rated insurance company for every single one of the invoices that we buy in this fund on behalf of our investors. So that was an important milestone for us. I suppose that the other very interesting project that we have in mind, and maybe after that we probably will pause for a while and try and manage as well as we can all these products. But a very interesting project that we have in mind and that we've been working on for a long period of time is litigation funding. Litigation funding is an area that has always attracted a lot of interest from investors because it's uncorrelated, it's easy to understand, although it's difficult to implement, and it basically is a very good complement to anything that any portfolio of assets, diversified portfolio of assets that private investors or institutional investors might have. What we're doing here is we are in the process of testing a niche strategy within litigation that has to do with litigation in the UK for products that were missold mostly to retail investors by the financial sector. The UK is a very interesting jurisdiction to do this because there are, at least for these type of claims, three ways of recourse. You have obviously you can go to court against these banks, and then you have two different entities, government organization that could grant to retail investors a compensation based on the losses that they have experienced with these products. The first one is the Financial Service Compensation Scheme, and the second one in the Financial Ombudsman Service, which both have the very important advantage of turning around the application very quickly, which means that it takes about, let's say, between 6 and 12 months to get an answer once a file has been submitted. We tend to operate in the region of very high probability of success. We're looking for success rates, probability of success as assessed by expert lawyers in the region of 60 to 70%. And lawyers are notoriously conservative when they give these estimates. And so, as I said, we've been working on this for quite a few quarters now. Everything is going in the right direction. We might be in a position, although this is no promise, but we might be in a position to offer some exposure to litigation funding in the UK along these lines at some point in 2020.
Okay, thank you very much, Laurent. So now the session is open for questions. So if you have any questions, you can click at the top of your screen in the Q&A, on the Q&A button, and start to ask your questions. We already have one question regarding the US election that is coming in November this year. So Laurent, do you think that the result of this election could have an impact on the return on composition?
It's an interesting question. I think that, well, it's somewhat difficult to answer simply by the virtue of the fact that the US presidency these days is a little bit unpredictable. You know, people who are involved in the country are difficult to, to predict. One thing we can say, though, is that, the Trump administration has been very active in various fronts with respect to the financial sector, and essentially it could be summarized by saying that all the effort that we've seen post 2008 crisis in terms of regulation, in terms of more compliance, has been somewhat reversed in its course by the current administration. So we're going in the direction of less regulation, less compliance, lower capital requirements for the financial sector, which all in all is probably on margin not a very good thing for us. Why is that? Because a lot of the things that we do is based on the fact that the financial sector is not working very well. The reason why we can get in the UK, almost double-digit performance in our real estate funding fund is not because, we're taking high-risk projects. It's because the banking sector is too slow or not willing to fund these are small projects, and that's because they don't have the resource, the need, or the appetite for compliance at on that level. That's the case in the US, of course, as well. And basically, the current administration is trying to basically improve the ability of the banks to do their jobs better to an extent. I'm not quite sure they're doing it the right way, but that's what it is. So, depending on who is being elected next year, if it's a Democrat president, for example, I would see that as a positive. If it's Trump again, I'm not sure it's a negative. It's probably not a positive, but it's probably not a negative either. It should be said that we're not very present in the US. We do lending in the US, but the US tends to be a jurisdiction that is marginally more efficient than other jurisdictions when it comes to private debt. And so we prefer to focus on jurisdictions where we have a disproportionate reward for the risk we're taking.
Thank you, Laurent. We have one last question so far. This is regarding, of course, to what's in the media at the moment, the coronavirus. Do you think that this virus could potentially have an impact on the performance of our strategies in 2020?
Again, it's difficult to tell. It's early days. I think that the headlines are maybe a bit dramatic in the sense that, yes, there's been casualties, of course, but it's mostly concentrated for the time being in China. The Chinese authorities seems to be doing what they should. The expansion of the pandemic. I would say that the main area where this should have an impact is global trade. So global trade should be impacted. As you know, we don't have that much exposure directly or indirectly to global trade. I guess the one bit of the portfolio that is potentially exposed to global trade is trade finance, but we do operate in a niche where we do ship mostly in the Mediterranean basin. So I don't think that has a massive impact. So far, we certainly haven't seen anything that would lead us to believe that they should have an impact. However, the advantage of having a liquid portfolio is that as soon as we see an area becoming less attractive for our capital, we'd of course reduce the exposure potentially to zero. But again, so far nothing leads us to believe that this should be the case. So we're obviously monitoring the situation very closely together with our CIO Pascal now. and we'll be ready to take action should things change dramatically.
So we have one new question, Laurent. I'm reading it. If you ever have to size the collateral, how long can it stay on the balance sheet? So basically, do we have any rules that prevent us to keep an asset on the balance sheet for over a period?
It's a very good question. It's basically a balancing act because typically when we seize collateral, according to the loan agreement that we've put in place, that means that the rate of interest that we're charging is higher and sometimes very substantially higher than the regular rate of interest. So for example, for activity in the UK, we tend to charge, and the market is quite homogeneous, we tend to charge about, let's say, between 8 and 12% per annum. If there is a default, this rate of interest jumps to, let's say, 23 to 33% per annum. We take the collateral, we have very low LTV. So typically, we have almost an incentive to take all our time to sell the collateral and pay ourselves. However, the flip side of that is that when we have collateral on our balance sheet, that means that on the margin, our balance sheet is a bit less liquid. So our policy is to essentially try to extract the most value from the collateral, pay ourselves as quickly as possible, and move on. As a matter of fact, the default rate in the portfolio is extremely low. Typically, it takes place in factoring for small invoices. The recovery on that front is very high. Most of the time, or almost always, substantially higher than the money that we are owed. So basically, the bottom line is there's no hard rule that says that at some point we have to get rid of the collateral. We don't want to sell at a distressed price, but at the same time, time plays in our favor when there is default.
Great. Thank you very much, Laurent. And I would like to thank our attendees and for your interest in the Katch Investment Group. Our aim is to be as transparent as we can with everything that we have in the portfolio, and we will aim to give you an overview, the same overview of our portfolio next quarter. So the next webinar will take place in May this year. And again, thank you, and we hope